So something weird is happening in our economy right now. Foreclosures have risen by 20% this past month, year over year. And this is the 8th straight month of foreclosure increases that we've been seeing. In other words, we're seeing back-to-back increase of foreclosures, and it appears that this is just getting started. But is this a repeat of a 2008 like real estate market crash with a giant wave of foreclosures? Or could it be something else? So what exactly is going on, and is this something that we should all brace for impact? By the way, guys, my name is Kwak, one half of the Kwak brothers, a certified financial education instructor and a real estate investor. And I've been teaching finance for nearly a decade and helped over 3,500 homeowners pay off their mortgage faster in the process. And today, I want to break down what's actually going on with these foreclosure increases, what I believe is going to happen in the next coming months. And I want to point to something that a lot of people aren't necessarily seeing or talking about that I believe is concerning. So grab your coffee, relax, and let's dive right in. So first, let's establish what actually is going on with the foreclosure increases with real facts. Just recently, CNBC, MarketWatch, and Realtor.com all reported that foreclosures have jumped 20% year over year in October. Now, like I mentioned, this wasn't a one-off event. This is the 8th consecutive increase of foreclosure starts. That means we're seeing more and more households enter foreclosure for the past 8 months straight, indicating that we're starting to see a bit of a trend. Now, it's important to note that these numbers are based on foreclosure starts, which is the first phase that all foreclosures go through. And typically, it could take anywhere between 6 to 36 months for the foreclosure to complete depending on the state you live in, whether it's judicial or non-judicial state. So typically judicial states like Illinois or Florida will take longer, whereas with the non-judicial states like California being a lot quicker when it comes to completing a foreclosure. However, not all states are experiencing the increase. The top states that are seeing an increase are California, Florida, Illinois, Nevada, and Utah, with Florida having the highest foreclosure in October 2025. So what exactly is causing the increase in foreclosure starts? Now, it's hard to pinpoint to just one main cause, but just in the last 6 months, we can begin to see some of the cracks in the foundation of our economy getting larger and larger. In the past 6 months, we've seen major companies in the United States initiate large-scale layoffs, like UPS laid off roughly 48,000 workers, Amazon 14,000 laid off, Nissan 11,000 laid off, and Verizon Wireless just recently cut 15,000 jobs in just a matter of a few days ago. And to make matters worse, many of these companies began a hiring freeze this year, with 2025 being the lowest in terms of new monthly job gains. And so what that means is that companies aren't taking as much risks when it comes to hiring new staff, and this makes me believe that many businesses are bracing for an economic slowdown. So with thousands of being laid off and no new jobs being added at the same time, this certainly could leave thousands of people stranded without any income whatsoever. But the situation gets worse as the interest rates remain high, so it becomes more challenging for businesses to borrow and therefore funding any new investments. And it's typically that these new initiatives and new investments that businesses make that kick off new hiring decisions. And the condition of the economy is further aggravated by the fact that consumer sentiment is at its lowest point in the past 8 years. So in other words, people are less reluctant to spend their money and take on risks when it comes to financial decisions and doing any sort of discretionary spending. Both businesses and individuals are leaning towards less risk, less spending, and less optimism overall. So when we zoom out and take a look at the economy as a whole, we can definitely see the cracks, and it appears that we're headed in the wrong direction. We got massive job losses, no new jobs being added, interest rates are still high, and consumer sentiment is at its low point. These ingredients are going to squeeze the middle class as prices are high and the money isn't circulating enough or fast enough for a vibrant growth in our economy. And so all of these could be the ingredients as to why we're starting to see foreclosure rates steadily climb back up. But let's go and zoom out even further and let's look at a longer time horizon. We can definitely see that our current foreclosure start rate is still relatively low compared to what we've seen in 2008, like much lower. So Yes, while we're seeing a back-to-back increase or foreclosure, it's still nowhere near the 2008 level, and most homeowners aren't losing their homes. But this did got me thinking a little bit. Could the steady increase of the foreclosure start rate be pointing us to something even more sinister? And while doing my research, here's what I'm finding to be more concerning, and it's not about our mortgages. Take a look at this chart right here. This is the total balance of credit card debt in the United States over the last 5 years. And in just the last 5 years, we've witnessed credit card debt rapidly increase, well surpassing $1.1 trillion in total credit card debt, which is the highest we've ever seen and been in terms of the balance. I mean, even looking back during the 2008 market crash, the credit card balance barely hit the $400 billion mark. Today, we're nearly at 3 times the amount that of the credit card debt when compared to the 2008 levels. Now, this makes sense as cost of living has definitely increased and credit cards being very accessible, consumers are running to their credit cards for purchases. But where I see the cracks getting larger and larger is the sheer cost of interest. Just take a look at this. This right here is the year-by-year interest rate on credit cards, or at least the average interest rates on the credit cards. Never in the last 30 years, we've seen the average credit card interest rate this high. So if you take a look at before the pandemic, we've seen the average credit cards hover just around 12 to 16% at most. But just in the last 3 years, we've seen the credit card rates hike up to 21 to 22%. And this may not feel or seem like a whole lot, but it definitely is a massive change. So what I see here is that credit card balances are at all-time high, and the interest cost is at its highest as well. And that's not all. There are other signs pointing to even more cracks in the economy. In fact, vehicle repossessions are surging at pace on par with the 2008 Great Recession. And so CBS News is reporting that nearly 3 million cars could be repossessed by the end of 2025, which is very similar to the numbers we've seen in 2008 market crash. Definitely not good. So when we look at the big picture in terms of the economy, in terms of job layoffs, interest costs rising, fear in the market, and even seeing increasing car repossessions, it's not hard to say that the American consumer is definitely feeling the squeeze. And I hate to say that we actually might be in a silent recession beneath all the tech and AI boom. But what does this mean for you and I in the next coming months? I mean, what could possibly happen? Now, my personal opinion and hypothesis is that we're gonna see foreclosure rates to continue to climb up, but not as bad as perhaps credit card delinquency, as well as the auto loan delinquencies as well. And we're already starting to see the delinquency rates trending upwards for both credit cards as well as auto loans. And I don't think we're seeing the cracks and the fractures in the stock market just yet because of the AI boom, like NVIDIA, AMD, Palantir, all these AI related companies are definitely seeing a surge that might be driving up the stock price as a whole, but beneath it all, we might not be seeing that big of a shift or boom as we might be thinking. But my personal opinion is that once the AI boom comes to a grinding halt, I just have this feeling that we'll actually see the fractures on the economy in terms of affordability and growth. And the data is going to suggest that we're not in the best spot in terms of the economy. Now, will things like the federal interest rate cuts and the tariff dividend checks help? Sure, but one thing we all need to know is that the economy thrives on stability and predictability. So yes, I do believe that the interest rates do need to come down, but unless small businesses and individuals feel stable, they just aren't willing to take the risk and spend the money that the economy needs to stay vibrant. But these are just my thoughts and my opinions. What do you guys think? Do you think that the economy is great and it's all that it cuts out to be? Or are we actually in a silent recession and it's not as great as what most people think? Let me know what your thought is in the comments down below. So what are some practical things to do to protect yourself, your finances, and really arm yourself to weather the season? Well, one, if you're not personally budgeting, you're basically flying blind. I believe that every major financial decision starts with knowing how much is coming in, how much is going out, and how much are you keeping at the end of every single month. And sometimes just by budgeting, you'll find yourself making better and wiser decisions with your money. And in other times, you may have to make a conscious decisions to cut back on expenses just to keep your budget in positive savings. Number 2, pay off your debt as much as possible. Time and time again, historical data shows that it's always the businesses and individuals that carry too much debt that loses in recession. So pay down your credit cards, consolidate them if you have to. Don't get trapped by the interest costs because it will eat you alive. Number 3 is to learn new skills and outfit yourself with new learnings every day. I believe that one of the ways to increase your job or income security is to become indispensable to your employer and your clients. And you do so by continuously creating value by demonstrating new skills or just simply a new area of knowledge. So as an employer speaking, because I have many employees of my own, not only could you keep your job for longer, but you'll probably be looked more favorably for that next job promotion or advances when it comes up. So friends, like all economic recessions and headwinds, this too shall pass. My goal here today wasn't to spread panic or fear, but rather give you the knowledge and insight that you need to stay ahead and to arm yourself in times of headwinds and recessions in the economy. But at the same time, recessions are times where wealth is created, and you do so by continuing to educate yourself, to create investment opportunities, and seeing what others aren't seeing. So I don't necessarily believe that this season we're in right now isn't just all gloom and doom. I do believe that it can be an opportunity if you know how and what to look in terms of creating wealth and making sound investment decisions. So once again, friends, be sure to leave your thoughts and questions below. Give me a thumbs up for the algorithm if you thought this video was valuable, and we'll definitely see you in the next video. God bless.